Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Today we're reviewing another SPAC investor presentation. So get ready for about an hour of me talking. Can your day get any better? Yes, it probably can. The SPAC we're looking at today is Mirion Technologies. This one is going public via GSAH, the second Goldman Sachs SPAC. This one peaked at about $15 in February when the SPAC mania was in full swing. It's down to $10 again, and it's still slightly above $10 after the deal was announced, which, if anything, is kind of a good sign in SPAC world these days. Again, SPACs have a $10 floor, so anything above it is good, but there's also a lot of SPACs trading below $10 even after a deal is announced, so that's interesting. For some people, this might have been a disappointing deal. They were hoping BlockFi, something blockchain-based, something EV-based, something hip and hot and cool. What they got is, a nuclear measuring device company. But that's kind of the Goldman Sachs playbook. If you know their first SPAC, WRT, kind of a picks and shovel play on a certain industry, and Mirion is sort of the same thing. And Vertiv has done very well for investors who bought in at $10. Yes, there was a dip. Again, that was during the pandemic when everything was dipping. Since then, it's kind of been on an up and up trajectory. Pays a dividend apparently. I'm not sure if that's true. Yahoo is sometimes wrong, but has a $9 billion plus market cap at this point, $4 billion in revenue. So they are seeking revenue producing companies that they can take public or buy from somebody and kind of work within an industry that they think has potential. So apparently they think the nuclear space has potential because they're taking Mirion Technologies public via SPAC. And let's look at what the deal actually looks like and what it means for investors. So got some pictures of a guy looking at brain stuff. We got some presenters, best in class sponsorship. You've got a $200 million pipe that Goldman Sachs is anchoring themselves with an additional $125 million in backstop in case of redemptions. Although, assuming it trades above $10, you probably wouldn't get too many redemptions. It's a revenue producing company, but again, who knows? Same company with VRT. You've got another $5 million pipe from Larry Kingsley, and then you've got management and Charterhouse Capital, which currently owns Mirion, rolling over about $390 million of their equity. It's pretty good. And I think actually Larry Kingsley is going to become chairman of the company. That's why they're showing him here and kind of showing that, hey, when he was in charge of these two other companies, it did way better than the S&P 500. So who says history can't repeat itself? So why they believe Mirion is a good investment. It is well positioned. It has upside potential, and it is a compelling risk reward opportunity. So they are the global leader in ionizing radiation detection and measurement technologies. So this is the type of company that makes Geiger counters, that makes dosimeters, etc. Again, if you want to know if 3.6 Röntgen is not great, not terrible, this is the company you go for. If it's 15,000 or above, you're probably boned, but they'll tell you that. High incremental margins, high barriers to entry, strong product leadership. I think this company also has pretty decent recurring revenue, which is kind of what you want, and we'll kind of see that in the future, hopefully, depending on what they show in the presentation. Significant upside potential, solid short and long-term organic outlook. They're going to target 1% to 2% market outgrowth. I think a market such as this one, a nuclear reactor-based, nuclear medicine-based market in general, probably won't be amazing growth. But if they can grow, a couple of percent above what the market's growing, certainly that can be relatively attractive in relation to other investments that are comparable, or even something like the S&P 500. Sometimes when it comes to some of these mature companies, for me, it's like, hey, do I want to just invest in the S&P 500 and kind of know what I'm getting long term? Or do I think there's upside potential versus the S&P 500, or potentially even upside potential with less risk than the S&P 500? Because companies like that do exist. That's the easiest comparable, even if it's not in the same industry, right? Obviously, the S&P 500 is a ton of companies. It's 500 companies. This is one, but that's the majority of people's money just goes into the S&P 500. So if you want to invest in something else, you probably want some upside beyond what the S&P 500 offers, or potentially some downside protection. I'm not saying it offers either of those, rather, but it could, depending on what we see in the presentation. And then you've got 300 to 500 basis points of near and long-term margin expansion driven by a bunch of other things that they could certainly bring. And then there's a compelling risk reward. It's a well-structured transaction, highly predictable and recession-resistant platform. And that's kind of an interesting play. There's a sizable pipe that Goldman themselves are anchoring. They're putting their own money into this beyond what they have as a sponsor. And in this cycle of the market, you're sort of reaching the spot where we've essentially been in a bull market for 12 to 13 years, since 2008, 2009. Certainly there was a little bit of a recession, a mini recession between then, but those never really stuck around, and they never really did anything major in terms of being hard on investors if you have a long-term mindset. It was kind of like a couple month dip here and there, and then massive recovery super quickly whenever it happened, kind of at the end of 2019, maybe 2018, obviously the pandemics, etc. So if we are moving towards a prolonged recession and they're sort of thinking maybe we need some investments that can be recession resistant, this might be the type of play. And you've got 70% of your sales that are mission critical and recurring. If you run a nuclear reactor, you probably need these things often and always, to just make sure that you're not exposing your employees and the people who run that reactor to undue radiation. Same with nuclear medicine. The people who run those facilities and use those machines, you have to make sure they're protected as well. And the stuff they build is certainly doing that. You've got a strong free cash flow conversion, using the deal to deleverage to boost that free cash flow conversion, and then improving optimization to boost free cash flow as well. And you've got a strong acquisition pipeline and a proven track record of value creating M&A. So let's look at the deal structure itself. Blah, 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 blah. Value of 2.56 billion, 13.3x 2022 EBITDA of 192 million. Got a lot of things over here. You have a transaction that's funded with 750 million in cash and 900 million of PIPE proceeds, with 200 million of that coming from Goldman Sachs. So it seems like a lot of institutional investors are interested in this deal. They're kind of looking at this probably from the same lens that Goldman Sachs is looking at it and saying, hey, we've got this kind of recession-proof business. If we are due for a recession, maybe this is something we want to be invested in for the long run, and potentially even as it dips during a recession, the revenue will still be relatively steady. You've got a net leverage of 3x based on 2021 EBITDA of 172. So EBITDA growth is there. So if you sort of look at 2.56 billion, which is 13.3x of 192, it's probably closer to 15x of 2021 estimated revenue, which is sort of baked in. If you compare that against something like the S&P 500, which is probably in the 17 to 18x range at this point, given where prices have gone and where earnings have gone, seems fairly valued as long as it's growing at around the same clip, which is, in the 4 to 5 to 6% range. I mean, if you sort of look at that price point for the S&P 500 and you look at the growth it's gotten since 2018, you're paying a lot for that growth. Clearly, there was a pandemic within those years, but there was a pandemic here as well. Even if you exclude the pandemic, the growth really hasn't been all that amazing. So valuations have expanded, and the valuation here seems interesting as long as the growth is sort of in line with what you're getting. So the deal itself, a lot of cash here, but they are buying it from a previous owner. A lot of the money just goes towards cash consideration to the previous owner. Sure, they're rolling over, 390 million of whatever they had in the past, but a lot of that money just goes to Charter or whoever owned the company before. Who was it? Charterhouse Capital. So they're getting a significant chunk of change, which is, not fantastic because it doesn't go towards the company's balance sheet, but there's still money left over to probably pay down debt, which is really going to be needed in a company like this. Because sometimes when you have these private equity buyouts, then the companies just starts bolting on other companies to grow revenue in order to potentially flip it out into the future. These companies tend to take on a lot of debt, and some of the debt even comes with relatively high interest rates, as it may be taken on from the actual parent company. So we'll see what the deal is structured like, what the interest charges look like. And then they have a fully deferred promote. That's interesting. Let's see what that says. Is there anything about a promote? So reference Goldman Sachs intends to syndicate up to a full portion of the PIPE. Private wealth and blah, 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 blah. May invest in the PIPE, and assuming maximum redemptions, net leverage will be 4.5x. And Goldman Sachs's PIPE investment will be 225 million. GSAH to promote shares held by the sponsor will be deferred, with 1/3 vesting at $12, 1/3 vesting at $14, and 1/3 vesting at $16, and will be forfeit after 5 years if targets are not met. So this is really what you want to see as an investor in SPACs. Again, SPAC promoters get a certain percentage of shares essentially for free for running the SPAC and finding a deal and kind of coordinating it all. So when that promoter basically says, hey, we're not taking any of that until we reach a certain price point, 100% deferral is somewhat rare and very good to see, and really adds to investor confidence, because essentially Goldman Sachs is saying that if the price point doesn't reach $12, we're in it the same way you're in it. We're getting nothing for free. We have this $200 million pipe in there that we're putting our own money towards as our investors at a standard price of $10 a share, assuming you bought at $10 a share and weren't unlucky enough to buy at $15 or made the poor decision to buy at $15 really. So you've got a 1/3 vesting at $12, so 20% return, 1/3 vesting at $14, 40% return, and 1/3 vesting at $16, 60% return. And they have 5 years to reach that. Certainly 20% return in 5 years isn't great unless there's a recession or something, but it certainly shows confidence in the deal itself. So Mirion Technology, you've got John Smith, Dosimetry Services Division. They are the global leader in ionizing radiation detection and measurement technologies. Again, they are measuring radiation, essentially what they do. They have an end market revenue that's kind of broken out by this, that shows this breakout. You got 39% in nuclear, 44% in medical and labs, and 17% in diversified industrial, mostly in North America and Europe, not a lot in Asia, which is somewhat concerning. I think if you look at where nuclear reactors are coming online, a lot of those are in Asia, a lot of those are in China. So what are they doing to grow that revenue? Potentially that's the growth opportunity, because a lot of those reactors are coming online in China. But hey, maybe there are other players in that space that are bigger in China already and in Asia already. High barriers to entry. 72% of their revenue is recurring, which is good to see. 6% comes from projects, 21% comes from others, and they have top 5 customers are about 21% of their revenue, and then 79% comes from other customers. So not too concentrated with one customer. You've got $689 million in revenue, so you're talking about 2.5 million, maybe a 3.4x revenue multiple. Pretty good. 2.6 divided by 0.689. What does that do? 3.7, I guess. So compare that against the S&P 500 again. That's about 3x. The S&P 500 has an EBITDA margin of about 18%, so you've got a 25% EBITDA margin here, pretty good cash flow conversion. We're talking about end market growth of about 4 to 6%. I'm assuming that means in between 2020 and 2026, and if they're targeting 1 to 2% above that, then you're sort of in the 5 to 7% range, or 6 to 8% range. Pretty good if that's the valuation you're getting. In terms of a price over sales, it's a bit more expensive than the S&P 500, but better margins. In terms of price over EBITDA, it's better than the S&P 500 due to those better margins. And then you've got a growth rate that's kind of probably in line with what you would expect from the S&P 500. I mean, it's quite possible that the S&P 500 growth is actually more lean than this, given what we've seen in the past couple of years. Again, like I said, the S&P 500 has gone up 10% between 2018 and 2020. There were some years where the growth rate was in that 7 to 8% range, but on average, it's kind of been in this range as well. So if they can beat that, then the valuation seems quite interesting. So nuclear power, what do they do? Where they're involved in the construction phase, which takes 3 to 5 years. They kind of show what they do: surveillance, penetration assemblies, in-core detectors and software detection portals, etc. Then you've got your operation, you've got monitoring, dosimetry solutions, in-core detectors, etc. And then you've got the decommissioning and decontamination part of things, the 10 years of that. They've got cameras and gamma waste array systems that are involved. So they're kind of involved in the entire life cycle of a nuclear reactor, which apparently is anywhere from 50 to like 100 years from construction to decommissioning, and decommissioning takes forever. Then you've got the labs and research part of things where they're actually working on certain things within the nuclear reactor. And you've got the civil and defense part of things where you've got, hey, dosimeters for battlefields, radiation detection systems for battlefields, etc. So clearly a small part of their civil and defense over their overall revenue, but it's there. Then you've got your labs and research part of things over there, which is the small part of the revenue. You got your nuclear power making up a good portion. Then you've got nuclear medicine, which is clearly probably where they see potential for growth here. Radiation therapy, software, hardware, alignment, measurement, etc. A lot of interesting stuff, whether it's used in hospitals, clinics, etc., dental offices, veterinary offices, etc. Essentially, how much radiation are you exposed to over time, so that you can be exposed and limited. I think there's actually like stickers you can put on your coat, for example, that kind of tell you how much radiation are you exposed to. So these are sort of reusable, but they're reusable to a point. They have to be replaced after a certain amount of time, right, as it fills up. But it's certainly something that's mission critical when it comes to nuclear medicine, because you want to make sure that the people who are getting the treatment, but also the people who are administering the treatment, are protected from radiation, because it's not fun if you are exposed to radiation, as certain TV shows have shown me. So what do they do? Industrial technology segment, medical segment, adjusted revenue of $465 million for industrial technology, $224 million for the medical segment, better EBITDA margin for medical, but also pretty good in industrial technology, whole body contamination monitoring, germanium detectors, a lot of detectors basically. Also some software as well, which is probably a higher margin business, 97% in medical here. Over here on the industrial side, you've got 57% in nuclear, and then the rest is kind of labs, industrial, diversified, etc., research. They are a resilient performer. They kind of mentioned that before. Clearly, there's been a lot of growth recently. I'm assuming, without knowing much about the company, that somebody bought them in 2015, maybe 2016, and they said, hey, we got to grow this thing so we can sell it later on. But you can kind of see why they say it's a resilient player. If you look at the global financial crisis, they actually grew at a pretty decent clip there. They continued growing. You had a mini recession apparently in 2015, but there's continued growth. Some ups and dips here. Clearly some numbers here that show why impacted by pull forward or one-time revenue related to the Fukushima incident in 2012. That was that long ago. Wow. And they've got the pandemic, an integration of a new company. I believe they acquired a company towards the latter part of 2020 or maybe even 2019 that sort of improved. Actually, it's 2020, but I think this is pro forma revenue that includes that. So you're kind of seeing relatively steady growth. Hard to compare because there's a lot of acquisitions here. There's Canberra, there's Sun in 2020 that they're using as pro forma revenue. So kind of flat during this integration phase, growth during this phase as they acquired Sun, but also that's pro forma, so it includes that. During the pandemic, they grew at 4 to 6%, and then plan to grow again on a go-forward basis. So seems like there's some organic growth in there, clearly some acquisitional growth, but you've got 4% organic growth between 2005 and 2021, and then acquisitions are driving a lot of their revenue growth beyond that, so inorganic growth is certainly there. 2005, they were formed. 2010, they strengthened a leading platform organically. Then they acquired Canberra, which is transformational, created an unprecedented global platform with a broad portfolio of offerings, and then they are kind of gaining share and expanding into medical and life sciences markets through their knowledge of the nuclear space, but also acquisitions that have given them the ability to move into that. Key investment highlights: large, stable, and growing end markets, leading competitive position and long-standing customer relationships, strong, resilient business model with strong organic growth profile augmented by attractive M&A pipeline, multiple paths for continued outperformance, and a best-in-class management team. So you've got your growing and stable markets. You've got the medical space, which is 33% sales, which has a higher forecasted growth rate than some of these other spaces, including labs. Then you've got your nuclear, which at a certain point, you sort of say, is it mature at this point? Probably. I think nuclear is a very, very good energy solution. It's just a lot of people don't like it. And there are quite a bit of alternatives that are emerging, whether it's solar, whether it's wind, whether it's hydro. And I think nuclear is just kind of got a bad rap because of the things that happen when a nuclear reactor melts down. It's not great PR when stuff like that happens, and people just have that in the forefront of their minds, and nobody's wanting a nuclear reactor in the backyard of their home because, if the 1 in a million chance of a meltdown does happen, stuff goes sideways really quickly. So you've got a market that's 4.3 billion in potential revenue, a growth rate of 4 to 6%, and a target of 1 to 200 basis points of annual outgrowth. So if you can get 8% growth and this forecast is reasonable, then you're in a pretty good spot. I think why they're kind of saying that, hey, we historically have grown in the 4% range organically. There's certainly been acquisitions that have gotten us beyond that. Can they now actually hit 4 to 6 to 7 to 8% in organic growth beyond even M&A, and then improve that with M&A? And maybe part of that is M&A potentially, right? They've sort of expanded into this healthcare space, which is just a better grower than nuclear reactors at this point. So clearly there's more upside than the 4% they've grown in the past when they were purely a nuclear power plant play. Now they're more diversified. So potential for growth is certainly improving, and potential for expanding margins is certainly there as well, as they kind of take on these bolt-on acquisitions and make them more efficient. So in 2021, you've got 689 million in revenue. A lot of other players in the space that are probably, Thermo Fisher Scientific, for example, much bigger business than the 21 revenue here. I'm assuming this is just the 21 revenue from this business line, but they are the biggest player in the space. Apparently, they are in all 4 end markets here. Solid margin, slightly lower than some of the other players in the space. Certainly room for improvement, but again, potentially a lot of that comes from their product mix as well. If you're in the medical space, maybe your margins are higher. If your product range is broader, maybe your margins are slightly lower than if you're focused on certain things. You've got a pure play on this space. These other players, while they're in this space, they're not a pure play. And then you've got a mixed sales channel versus just distribution. And these guys are number 1 share in 14 of 17 categories. I think this is a space that's kind of fractured. So there's certainly a lot of space for acquisitions for Mirion, and they're going to be in a much better spot to do that. Not that this deal is done. Not that they've gotten some of this debt off their books. Long-standing customer relationships. Top customers are only 21% of their sales. So again, that's somewhat high. If they lose 1 or 2 of those customers, that's a big dip in sales. But if they have long-term tenured relationships, 10, 15, 40 plus years with some of these nuclear power players, if they're the biggest in the space, they are potentially the best. And they are able to put more money into R&D and research and all of that good stuff to drive innovation that these companies are sorely needing. You've got a higher reoccurring revenue mix. Majority of project revenue is already in the backlog here. You've got civil defense and research spending that's less volatile, with most sales to replace aging installed base, but a lot of the revenue is reoccurring with 1 to 5 year service contracts, etc. Not in discretionary. You can't just stop buying dosimeters if you're a nuclear reactor. You kind of need them. I mean, you could certainly switch to another company, but these are mission critical things that they need to keep buying, and they're certainly in a good spot to buy it from Mirion. And they have 5 to 6% revenue outlook, supported by a leading market position and attractive industry dynamics, and they have a robust M&A pipeline, additional opportunities that provides additional opportunities to expand in attractive markets. And I think what they're going to be looking for is, hey, we want to expand in the medical division. That's going to be 50% of our revenue in 3 years. They have 100 plus potential targets identified. More of them are in the medical split, which is, again, higher growth rate, higher margins, midterm, near-term opportunities. They're really targeting the medical space. And then they've got 6 active projects that they're looking at right now. A lot of them are in the nuclear, defense, and industrial division that they've identified and they're looking at. And a couple of them, the smaller ones, are in the medical space. So I think in the short term, they're clearly looking at kind of strengthening that nuclear space, which is their bread and butter, And in the long term, they're going to be looking at, hey, how do we get medical to become the majority of our revenue? Because we think that's going to be the biggest growth opportunity, where we can gain from some of the bigger players in the space that are potentially already there. They've demonstrated a track record of M&A, buying at an average multiple of 12.2x with a post-synergy multiple of 6.0x. Canberra was a big one here in 2016. Like I said, in 2020, they bought Sun Nuclear, which is a medical segment supplier. So clearly, a lot of the revenue growth is coming from some of these acquisitions, medical positioning here. So the last couple of years, they've been focused on either expanding geographic reach, Germany and Europe here, or kind of expanding that nuclear medicine blueprint to grow their total addressable market and also provide opportunities for growth. Organic growth drivers that they have: R&D, refocusing, software growth, which I think certainly has a lot of potential there if they can really get their software onto a lot more computers, improving their mix with medical to be more than 50% within 3 years, a network effect. So if there's more product offerings that they have via M&A, they can certainly sell it to people that they're already selling other products to. And then there is multiple nuclear power plant build upsides that are not even included in the plan. So if there are new nuclear power plants that are coming online that they're not contracted for yet, and they can contract it for those, then certainly the growth could be higher than shown here, which would certainly be good. And then you've got inorganic value creation, which I think is going to be M&A. And certainly this has been a company that has grown vastly via M&A. They've acquired, 2 or 3 companies that have basically doubled their revenue since 2015, more than doubled their revenue since 2015. So that's been the driver, and that's really the private equity playbook. They buy something for what they think is a decent value. They, maybe leverage the crap out of it to acquire new companies and grow revenue at a rapid clip, maybe improve margins, etc. Certainly do some good for the company in terms of improving profitability, and then sell it off to the highest bidder at a pretty solid return across 5 years. Because I think the company that bought Mirion in 2015 bought them for $750 million. So they're selling them for 2.6 billion at this point. I mean, clearly they've improved their revenue. They've doubled their revenue, more than doubled their revenue, improved their margins rather. So they've done a good job with what they started with, but pretty sizable return that investors are paying on it in terms of what it was valued at in 2015. So that's something to keep in mind as well. Margin expansion, portfolio growth in areas that are margin accretive, improving contribution margins, improving R&D and product management, improving pricing, optimizing supply chain, all that good stuff. And then you've got strong free cash flow, which is really what you want to see in a company like this. And I think this is what Goldman Sachs often targets. This is not a high CapEx company. They kind of do what they do, and they probably don't need a lot to make it happen. And they produce quite a bit of free cash flow, I would think, assuming the deleveraging is effective and there aren't a lot of missions. So you got a management team with a proven track record. You've got a board leader, Larry Kingsley, which we talked about before. He had a pretty good track record of beating the S&P 500 with companies he was in before this one. He's really entering the fray now to improve what they're doing. You've got pro forma historical and projected financials here. Pretty solid organic growth between 2019 and 2020. I think it's ticking up now due to the acquisition of Sun, but also basically because we're coming out of a pandemic, and there's certainly upside in some of the businesses that they have here. I don't think they're projecting ridiculous growth here. This is a company that's grown organically between 2005 and 2020 at about 4%. So now that they're growing 5%, that's not ridiculous, especially since they've acquired some new businesses since then. Clearly a company that's improved margin. The acquisition of Sun, a higher margin business is helping that. You've got solid cash conversion and solid EBITDA with decent growth, right? The idea here is that, hey, we're going to expand margin, and even though we're growing at 5%, our EBITDA might be growing at 9%. And if they can do that, that's pretty darn impressive. And a 25% margin. Again, this is 2021 expected, which at this point they probably have a good view into. So it doesn't strike me as something ridiculous. Free cash flow, an illustrative 2022 free cash flow of 120 million. So you're talking about some CapEx, cash interest, cash taxes, working capital. If you can get a free cash flow yield of 5.9% on a business like this that's growing, it's not a 20% grower. It's not technology or anything like that. But 5.9% yield on something that's growing at all is pretty good when you consider the S&P 500 has a free cash flow yield under 2% at this point. So, we've talked about a lot of valuation metrics that compare it against the S&P 500. And again, it's not an apples to apples comparison, but it is an alternative investment that's just easier, right? It's easier to make. And if you're getting 2% yield, free cash flow yield over there, you're paying 17x EBITDA over there because the free cash flow conversion is much lower on that. That's why the free cash flow yield is so much lower than this one. You're paying 3x revenue. Over here, you're paying 3.7x revenue, but you're getting 13 to 15x EBITDA valuation, and your free cash flow yield is 6% because of the very high free cash flow conversion. Starting to seem like a pretty good deal here to me. This is a business that's not going to blow your socks off in terms of growth. This isn't suddenly going to become a 20 to 30% tech grower that has a 30 to 40x multiple in a couple of years. So you can't really depend on the multiple expanding a ton, but you can certainly depend on the multiple expanding a bit. If you sort of say, hey, this thing has better financials than the market, and the market is priced at 17, 18x, why is this priced at a 13 to 15x, depending on the year you look at? So there's some multiple expansion potential there. And there's also the fact that, hey, maybe there's potential for growth beyond what they're showing here, right? This is kind of just organic growth of 5%. You've got 9% EBITDA growth. If there's acquisitions that are effective and they can efficiently integrate those and do well on that front, then this could grow at a decent clip. And now they're kind of showing the valuation against some of these comparables. And again, these comparables aren't going to be apples to apples. A lot of these businesses do other things. But if you're in the same industry with similar growth patterns, well, you've got a 15x against anywhere from 19 to 30x on some of these other industrial plays. You've got a 13.3x, 15x EBITDA in 21, 13x in 22 versus 17 to 29x. And again, that kind of ties back to my S&P 500 comparison. Then what are your growth rates like? What are your margins like? Those are important things that you have to take into account as well. So yeah, for example, Meter Toledo at 31x. Hey, these guys are growing at what? 2.5% between 2018 and 2020, and Mirion's growing at 9.4%. Estimated growth in the future for those companies is a bit higher, which is why their multiples are higher, and these guys are growing a bit lower. But I think they're being relatively conservative with this projection. If you kind of look at historical growth, even excluding M&A, it was in the 4% range. Now you're sort of saying, hey, we're at 5 to 6%, and there's acquisitions down the line. I think that growth can be higher than this, and I'm not too concerned about that being optimistic. Your EBITDA margins are kind of in line with some of these other companies, growing at a better clip. But again, if you're starting at a lower point, then sure, they're growing at a better clip. And then you've got some potential for upside growth. And then excluding company costs, the EBITDA margins and growth rates are kind of in line with some of these other players, which are valued at a much higher clip. So again, even if you don't know enough about these companies, and I don't, that's something I'll say, I don't know enough about these companies to really compare them very well. The valuation seems relatively fair, if not good, for what you're getting. And like I said, you're getting a mature company, but that's sort of what you have to expect from Goldman Sachs based on what they did in the past. And this is kind of the deal. Ton of money. Most of the money is going to existing shareholders. That's the crux of the deal when you're buying from private equity or from another holder. $912 million does go towards debt pay down, which leaves them with a lot less debt than they started with. You're talking about $1.4 billion in debt being cut down at $520 million. So that's pretty solid. Deleveraging is going to be really really impactful on what they can do in the future. And their free cash flow conversion should mean that, sure, they can take on debt, but they should be able to fund some of these acquisitions just with the cash they're generating, if they can generate it as shown in 2022. Because I think they're actually free cash flow negative in 21 due to some of these debt covenants that they had. And I talked about some of the debt structures being onerous when you're owned by a private equity company or something like that. And that's sort of what you saw here. I believe they had some debt issues that are being resolved with the deal, which should really help the company flourish in the future. And you can kind of see that, hey, some of this debt is being refinanced at a much lower rate, taking them from a 4.8x net debt versus EBITDA to 3.8x in the future. So it's going to allow for significant deleveraging that's going to increase cash flow, a better balance sheet that's focused on growth, and then you've got better flexibility in terms of capital deployment in the future as well. Solid management team. This guy entering the fray, starting with this deal, really has done a good job in outperforming the S&P 500 with both of the companies that he was involved in. After 2015, I don't really know what he did, but he's just hanging out. And now he's ready to go. You've got your actual growth since 2005. That's kind of what you can see. This is adjusted, not pro forma in 2019 onwards. So pretty significant growth fueled by acquisitions between 16 and 17 and 18 and 19. From 2005 to 2015, American Capital had a 6.6x return on their invested capital, 2.5x for Charterhouse since 2015, 2021. And that's sort of what you're getting, a 12% growth rate adjusted for acquisitions. A lot of that happened in the last couple of years. If you look at organic growth, it's not amazing, but it's not terrible. This is sort of a mature business, and that's sort of what you can expect. But it's also a business that is going to grow through acquisitions. There's nothing wrong with that, right? You're adding companies that are potentially improving your margins and doing things that allow you to address a higher revenue base. Consolidation, the Mirion company grew from 110 million to 269 million between 2004 and 2016. They acquired Canberra, consolidated it, grew from 269 to 440. Now you've evolved into a diversified technology company with the integration of Sun Nuclear, which has strengthened their medical division to 33% of revenue versus 9% 2 years ago. And that's kind of what you want. One of the negative things that you can say about this business is that are nuclear power plants really going to be around 20 to 30 years from now? Are they going to be growing at all? Or are they going to be supplanted by other energy forms? And the answer is, I don't know, probably. I don't think nuclear is that much of a growth opportunity, but they see that, right? They see that, hey, we have this cash flow business. It's basically, hey, we're throwing off a bunch of free cash flow. It's relatively high margin. What we can do with that is we can acquire other category adjacent businesses that are probably going to be around far longer than the nuclear reactor space will be, and grow at a much faster clip as well. And that's pretty good management in my mind. You're kind of realizing what your limitations are and expanding beyond those limitations. Now, that's not to say that nuclear reactors are going to be gone tomorrow, right? At the end of the day, these nuclear reactors that are in place now, they do have a 40 to 88 life cycle. And even after that life cycle runs out, and during that life cycle, Mirion is involved with reoccurring revenue. Even after that life cycle runs out, there's still a 10 to 20 to 30 year decommissioning and decontamination space, which Mirion is involved in as well. So even if no new reactors are built, that's certainly not good for Mirion, but it's not the end of the world. They're still going to get revenue for quite a bit of time. It's kind of this reoccurring revenue base, which is all the rage these days. And that's really, really interesting. And they had 8 acquisitions in 2019 and 2020, right? The market growth is 4 to 6%. They are planning for 5 to 7% in organic growth, 10+% growth in acquisitions, and certainly a lot of acquisitions in 2019 and 2020. And there's probably going to be more in 2021 and 2022 to sort of get that transformation from a nuclear power play into a diversified business rolling. If they're going to be at 50% nuclear medicine play in the future, that's pretty good. Pretty good. So future projections don't seem outlandish. Clearly, they are aware of what their growth is in 2021 already. They probably have a pretty good idea. Even during 2020, when stuff didn't go so well for a lot of businesses, earnings and revenue was hit in a big way for a lot of industries. These guys actually grew. They're continuing to grow, and that's kind of why I'm liking this business model. This is certainly a resilient business model that is primed to continue to do well into the future and be a relatively safe haven during a recession. And then we kind of look at this free cash flow. And that's what I was talking about when you have these private equity deals. Their net income is negative primarily because you've got this massive net interest expense, which is includes sizable non-cash interest expense related to payable in kind interest payable to previous owners. So when you've got these weird ownership structures, they may be a net negative for investors if they weren't changed. So that's why, they're buying out the previous owner. They're getting rid of that debt, and that's really going to transform the company's cash flow structure to something completely different than what it was in the past. And it's going to open up a lot of avenues for acquisition beyond just depending on debt like they had in the past, right? Because they had such high interest expenses. Now you've got this free cash flow structure that is going to be really helpful for investors going forward, because you've got a net income of 37 million, which is, why is it changing so much from the negative 146 million in 21? Well, it's the 165 million in interest expense becoming 17 million in 2022 because of the deal itself and the restructuring of the debt and the deleveraging that they're taking on. And if you kind of convert that to cash flow, free cash flow, how does that 120 million happen? Well, it's non-cash expenses that you have here. Amortization and depreciation, 37 plus 62 plus 21, you get to 120 million in free cash flow. So I think you've got a really solid value story here. You've got a relatively fair valuation. Certainly a lot more than Charterhouse paid for them in 2015, but they've also kind of restructured the business into something completely different. And they're selling it for a good return for them, but that doesn't mean that it can't be a good return going forward for investors as well. I think there's a path forward for this company, the growth that's in the high single digit range, and that might not seem great in this type of market, but when you compare it to the market in general, that's pretty good. The S&P 500 probably is going to grow at like 6% in 2022. And that's kind of off a more normalized 21 year. 21 is probably growing at more than 10% because of the negative growth in 2020. So if the future growth rate of the S&P 500 is in that 5 to 7% range, and this is in the 5 to 7% range, and you're paying 13 to 15x for this, and you're paying 17 to 18x for the S&P 500, why not invest in this when it's also more resilient during a downturn? And that's kind of an interesting thesis to me. The valuation is relatively fair, and the company is interesting. You've got nuclear market information here, so ongoing revenue is the majority of it. New build is only 16% of it, but it's growing at a faster rate. This is basically inflation, right? It's kind of maybe we're raising our prices from time to time, and maybe there's some new builds that are offsetting some decommissioned plants. There's some other stuff that's being driven as well. New build is interesting that there's that much revenue coming out of it. Clearly, that's really driving some of this growth, but 70% of that new build revenue for the next 5 years is already in the firm backlog, so it's not like it's kind of up in the air. New build growth is driven by China, UK, Hungary, Finland, Turkey, Egypt, and Russia. Interesting that those are the countries that are interested in nuclear power. The US really doesn't seem to be at this point, although I did read some article about Jeff Bezos building a nuclear, was it fission or fusion? It's one of the ones that's not the one that's in use today in the UK in 2015. So potentially, different nuclear technologies come to market that obviously still produce radiation, that still make it a viable business for companies like Westinghouse, which run these reactors, and certainly keep Mirion employed in a variety of ways. But hey, this is it's not a growth opportunity, but it's a stable opportunity with some tiny potential for growth. And if you look at the nuclear power plants in operation, they haven't changed by much between 2005 to 2020, and they're not really projected to change by much between 2020 and 2026. But they are going to generate more electricity from nuclear in the future. However, it's clear that renewables are becoming a bigger and bigger piece of the pie. That doesn't mean that nuclear is going to stop to exist, but it's potentially going to stop to grow, right? It's going to be a flat install base. There's some new builds happening, but they're kind of offsetting other builds that are being shut down. However, hey, they are involved in the decontamination and decommissioning space as well. So in 2020, hey, there's a couple of plants coming down. There's 64 plants in 2020, 60 plants in 2021, a bit more in the future. The US is apparently the largest supporter of shutting down plants. I don't know what they're replacing it with, but hey, I'm assuming solar of some sort. And they are growing their decommissioning space as well, and they're planning to grow that into the future as well. Obviously not a good thing if these numbers start shrinking, because they are making a good portion of their revenue from nuclear. But as long as these numbers remain stable and they can kind of grow this decommissioning market, that kind of tells me that, hey, even though these numbers are increasing, the overall numbers are staying stable. There's still nuclear power plants being built in a lot of other countries. So that's interesting. I don't think this is the thing you're excited about, though, as a Mirion investor. This is probably the thing that you're least excited about and most worried about. It's the shift away from nuclear. However, it doesn't mean that nuclear can't come back. There are still proponents of nuclear power in a lot of countries. I think nuclear is the most efficient and probably most safe in terms of the amount of pollution you're creating, ways to create power outside of most renewable energy sources that aren't in a spot where they can produce enough energy to support the world. So if you kind of think about coal, yeah, you don't have a nuclear meltdown when you're doing coal, or you're doing oil, or if you're doing natural gas, whatever, but the amount of pollution you're creating is probably way worse in terms of the long-term impact on the world than a nuclear power plant is. However, when you have a nuclear meltdown like you had in Fukushima or whatever, it kind of just, it's a scorched earth type deal. It's like, hey, this land is ruined forever, which also isn't good. So I get why people aren't all that excited about nuclear power as a way forward. So it kind of gives you a bit of history and outlook of nuclear power. Again, nuclear is essentially, if you want energy independence, if you want low-ish carbon emissions, it's the way to go. The negatives of it are you could have a meltdown. Life cycle of a plant, kind of saw this already, but they're involved in all of that. So if you think about, hey, if there are 70 plants going online this year or next year or in 2025, when there's 70 plants going offline, they're involved in this space for those 70 plants, but they're also involved in this 40 to 80 year life cycle of these new plants that are coming online. So if you kind of think about, hey, is this company going to be around in 2050, 2060? Probably. I mean, there's still going to be nuclear plants running, even if they're not being built by 2060, and even if they're being taken apart at that point, then they're still involved in the decommissioning and decontamination space. And I mean, radiation is everywhere, right? You still need radiation detection in all sorts of spaces, whether it's military base, where it's, hey, what's the next frontier? It's space, right? What does space have? Radiation. So they're going to be out there doing stuff with this radiation dosimetry beyond our lifetime, probably. So, there's certainly a worry about the nuclear power plant growth stalling and maybe shrinking in the future, but I'm not all that worried about it being anytime soon. And I think there's significant lifetime opportunity for them to make money off of each individual nuclear power plant for basically 80 years plus. Right, and you can kind of see that here, that they're making 60 to 80 million in revenue at each plant, but that's very spread across the years, which is pretty good as an investor, right? You want that recurring revenue. You want that recurring revenue that I can eventually use to pay you a dividend, which I think this is the type of company that will eventually pay a dividend. Once they kind of reach an inflection point where they can't really grow anymore, this is a dividend play for sure. Not right now, but 5 years from now, definitely. And maybe even earlier than that. And you've got renewables. You can't add additional capacity very well. You can't be protected from fuel supply interruption with hydro, for example. Large-scale output capacity and baseload aren't really there for wind and solar at this point, but nuclear does that right now in a lot of ways. It does a lot of things that other things can't do, other energy supply areas can't do. And that's not going to be the case always. Wind's going to get better, solar's going to get better, hydro's going to get better. But right now, nuclear is clearly the winner in that scenario. Upside from small modular reactors, which I think was when they basically design and construct prefabricated things and kind of transport them to the installation site. Although I think Westinghouse went bankrupt because of something like this. They basically tried this with a couple of nuclear power plants in the United States, and for whatever reason, it wasn't working. It took forever to get these things over there, and they basically went bankrupt, and Brookfield Asset Management bought them out of bankruptcy. And again, you think, hey, something went bankrupt, must be a bad business model. That's not true. It was just bad decision-making from the owners of Westinghouse. So they went bankrupt, restructured. Westinghouse bought them out of bankruptcy. Brookfield Asset Management, a stock I own, BAM, bought them out of bankruptcy for $4.9 billion with maybe a $900 million upfront cash outlay, and they've turned that thing around and it's been throwing off cash like crazy. I want to say they're getting like a $200 million dividend every year from essentially a $900 million cash outlay on their own front because they sold it. They put it in other funds of their own that are funded by other players. So good for those guys. They really know what they're doing. But also it kind of speaks to the value of nuclear as a cash flow producer still even today, as long as it's run properly, because those companies can certainly do well, and they've done well for Brookfield. And now you're able to sort of own a picks and shovel play in the nuclear space if you don't already know Brookfield, and own a piece of that pie as well. So you've got this global market outlook that's growing at a pretty decent clip. We'll see if that works. You've got a first SMR in Russia in May 2020. So maybe this is a bit different than what Westinghouse was doing, but hey, who knows? You get your medical market overview, a growing population, a growing, more aging population. So certainly going to be a lot of need for medicine that's actually working and doing well. You've got an attractive growth profile here. You're highly profitable with 20 to 30% margins. You've got an increased cancer patient population. The global number of new cancer cases is expected to rise by 70% over the next 2 decades. Wow, what a bummer. But hey, we're going to make money out of it. That's great. Growing awareness of the benefits of radiation therapy for cancer patients. I mean, that's clearly the place to go. 3.05 million patients received radiation therapy in 2016, which is expected to increase by 37%, reaching 4 million by 2040. Well, this took a bummer approach right here. Everybody's going to die and we're all going to have cancer. But Mirion's going to make money because they are involved in the radiation therapy market. And again, there's always the potential for, and certainly even as a Mirion investor, I would hope that there's a cancer cure that makes all of this unnecessary and completely shuts down this revenue opportunity for them. But that's probably not the case anytime soon. So this is going to be a growth opportunity for them. And I think there's an opportunity for growth beyond the United States, right? The United States certainly spends a lot of money on healthcare, but so do other countries. And there's opportunity for growth, an example in China or some of these other countries where radiation therapy isn't all that penetrated yet, whether it's the rest of the world, APAC or China, and the opportunity for that growth isn't there in the United States or some of these European countries that have socialized medicine. But in a mature market, you're already making some money and having the cash flow that generates to invest in some of these other markets, because that's really what I want to see from this company. If you look at where is their revenue concentrated, it's in the United States, and it's Europe, it's in the UK. I would like some acquisitions that expand them beyond that, because sure, they've expanded beyond the nuclear power space into radiation therapy and nuclear medicine, but they're still very concentrated in those two geographic regions. And I think there's certainly upside in China, especially on the nuclear power front. I mean, they're going to be the guys that are building a ton of nuclear power plants to generate the enormous amount of electricity that they need to make that country work efficiently. So a lot of upside here. There's a global software market that's growing. They are getting into the radiation therapy software space. Decent amount of money to be made there, 20% growth into the future. Again, it's not going to be a huge portion of their overall revenue. The market itself is only $50 million in 2019 versus addressable market of $2 to $4 billion that they're in now, but certainly a lot of room for growth there. And this is probably a much, much, much higher margin space as well. So if they can grow in the software, radiation software space, that could only mean good things for their margins. You've got your dosimetry market, which is, again, measuring radiation exposure. Number of healthcare workers exposed to radiation has a 1% to 2% growth through 2026, a 2% growth in cancer cases, 1% growth in non-invasive treatment procedures, 1% growth in overall healthcare workforce. And you've got your increases of 2% to 3% annually, which is kind of giving you this 3 to 4% growth by volume and price increase, at least in the US. The market is highly penetrated. There's regulations in place for both the US and Europe. And I think that's what you are kind of going into this knowing, but you have a hope that some of that will transfer into China and the rest of the world, right? Because there's often a lot less regulations in terms of how you need to protect your employees and your patients when it comes to radiation treatment. And again, radiation treatment isn't a big thing apparently in China right now, but when it does become a bigger and bigger thing, you would want Mirion to be a piece of that pie. And for that to happen, you probably need actual regulation, because, hey, if companies can skirt laws and maybe expose their employees to a little bit of radiation, just a little bit, they are potentially willing to do that if not regulated. And that's certainly not what you want to see, but what might happen. And nuclear medicine is fast growing, highly attractive. You've got diagnostic equipment that they're in the thyroid uptake system space. They're in the patient dosing space for dosage and storage and measurement. They're the market leaders there. They're not really in this space, but certainly a lot of potential for acquisitions, and even the spaces that they're in, or maybe moving into other spaces that are complementary. Unfortunately, there is a growing cancer patient population, which is a real bummer, but there's radiopharmaceuticals, funding for development of new techniques. I mean, what if in the future you have a pill that has a little bit of radiation that it releases that you can swallow, that can specifically travel to where you have some cancer in your stomach and kind of just shoot it right there into a specific space. And maybe there's a little bit of a Mirion technology in there that measures exactly how much radiation has been released before you pass it in your next bowel movement or something like that. Hey, it could happen. I don't know anything about that, but hey. And then there's space. I mentioned space before, but it seems like they've already been involved in their custom design solutions. They've been used in some of the most important interstellar scientific voyages through the solar system over the last 3 decades. I mean, you certainly want to measure radiation in space in whatever way it may be out there. They've been involved in that. A bunch of the Mars trip, the Uranus trip, Jupiter, the sun, and a lot of other stuff. And clearly, as we travel more and more into space, whether it's recreationally or to do more stuff out there, I think there's going to be a need for stuff that Mirion Technologies produces, and a lot of upside potential in that area that hasn't been realized yet. So what do I like about this company? It's very reoccurring. I think it's a space that isn't going anywhere anytime soon. Again, even if you're very, very bearish on the nuclear power plant space, you can't argue with the fact that they're going to be around, and Mirion is going to be generating revenue from them for at least another 40 to 50 to 60 to 70 years, probably. Certainly there may be a slowdown in the number of reactors being built by 2030, 2040, when other alternative ways of producing energy get better and better. But hopefully at that point, Mirion has pivoted, as they've already started to pivot into, let's say, nuclear medicine, which is still going to be a thing, as cancer is one of the leading causes of death for a lot of people, and nuclear medicine is one of the most effective ways of treating it, even if it comes with a lot of side effects as well. Then they've got upside into other spaces. They've got a cash flow positive business that is now less leveraged than it was in the past, that they can use that cash flow and also maybe take on additional leverage to expand into other areas that are kind of category adjacent, but potentially improve revenue, addressable market, and margins and all of that good stuff. And there's certainly a lot of acquisitions that they've done in 19 and 20, and I don't expect that to stop anytime soon. The deal itself, again, most of the money does go to the sellers, Charterhouse Capital. However, the change in the amount of interest that is being paid between 2021 and 22 is massive, simply because they're using 900 million of that money to pay down a significant amount of debt and kind of get out of a onerous contract that they had with a previous owner. So you're going from 150 million in interest payment down to maybe 20 million, which is going to be absolutely huge in terms of the free cash flow generation that this company is going to have. And yes, if you look at this and say, well, these guys are losing money. Yeah, they're losing money, but most of that is interest expense, right? And that is and that is gone after this deal is consummated. So that's where the upside is. What's the downside? Again, it's nuclear power. Potentially not the most beloved way to generate energy these days, or ever, really, especially after the 2 or 3 meltdowns we've had in the last couple of decades. That's clearly the risk here. The other stuff all seems pretty good to me. The valuation seems pretty fair to me. 15x 21 EBITDA with a 5.9% free cash flow yield based on 2022 estimates. So, if the interest wasn't there this year, you'd probably be in the 100 million free cash flow range. So still a pretty good free cash flow yield. When you compare that against really anything else in the market, that's pretty good. A 6% cash flow yield against essentially 2% yield in the S&P 500, or even less at this point, I think. And then bonds that are paying 0. I'll take that. I'll take that. I am on board with this deal. I think Goldman Sachs sort of knows what they're doing, and I like the fact that they're putting their own money where their mouth is in terms of the deal. They're not taking any sponsor promotes until $12 is met, at least, and then most of that is not until $16, right? So you're at least in that same ballpark. They're buying at $10 because they're participating in the PIPE. They're not getting anything for free until it's $12. That limits dilution for investors, which is good to see. I mean, there's certainly going to be some dilution, and they're actually being pretty upfront about the dilution here. Hey, there's an implied dilution of 9.6%, but that's only at a $20 price point. You've got your warrants coming in the $12 range, but there's not a ton of dilution here. The SPAC founder shares don't really come in until the $12 range. They're out there in the $20 range. The public warrants and the founder shares aren't really there until the $12 range. So pretty decent dilution here in terms of other deals that are structured this way. The SPAC itself owns almost 37% of the company because it's essentially a full buyout from a private equity company. You're not taking a private company public. You're buying it out from somebody else. The PIPE is massive, right? And the founder itself is 10% of the overall, or 20% of that PIPE, which speaks volumes for what the institutions think of this deal. And again, that's not to say that it can't drop, but I do feel pretty decent about this deal. I would say, as far as deals go, it's a pretty good one. And yeah, nuclear reactors aren't the sexiest high growth business, but you're getting at a good value for a a solid revenue generator that's mostly reoccurring revenue that's probably going to grow at the worst case sort of in line with the S&P 500, and it's valued at a better clip than the S&P 500 is valued today, and is probably going to do better in terms of at least generating revenue during a downturn than most of the companies in the S&P 500 will, because it's proven that time and time again that it has recession durability. That's not to say that if a recession happened, the stock won't drop 40%, because stocks do that even if they're continuing to generate revenue. But if that's the case, they'll continue generating cash flow during a recession, which they can then use to buy other companies at a better deal. And when the bounce back happens, they'll just be in a better spot because of it, because they don't have to take on debt, because they don't have to leverage more, because they can acquire companies at a very opportune time. So I think this is solid. I like these free cash flow generating businesses. I like these businesses that have revenue on the books already, that are consistently growing, that are active in the M&A space, and this is certainly one of those businesses. So overall, I'm digging it. I might buy some more, but I have a decently sizable position already, so we'll see. Overall, this is a buy for me. However, remember, guys, please remember, I'm not a qualified financial advisor. Please do your own due diligence before investing in Mirion Technologies and talk to a qualified financial advisor. However, for me, this is a buy and hold for a while. I'll see how it plays out. I don't expect this to jump quickly. Again, the transaction probably won't close towards the latter part of the year. However, as we've seen with some of these revenue generating profitable businesses, they've done relatively well after the de-SPAC happens. So maybe that'll happen as well. But this is probably a long-term hold for me, honestly. I kind of like what they're doing. I like the transition to the medical space, which is higher margin, less risk, higher growth, and then kind of moving into adjacent areas from there and improving margins and targeting growth in the 5% plus range with strong free cash flow to drive acquisitions that improve that as well in the future. So guys, thanks for watching. Have a good day. Don't forget to leave a like, subscribe, all of the good stuff. So let me know what you guys think about GSAH. Let me know what you guys think about Mirion. And thanks for watching. Have a good rest of your day.